Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. There's evidence today that corporate insiders of technology companies are offloading their stocks on this recent rally. Now, of course, the SP 500 index itself, the US stock market has been very strong recently. And in fact, a lot of that strength recently has been driven by XLK, the technology sector of the S&P 500. That's a massive component of the S&P 500. Just Apple, that has been on a big rally recently, makes up almost 7% of the S&P 500's weight. So if corporate insiders of companies like Apple are selling their stock right now, does that give us a warning signal for the stock market that has been pretty much held up by these tech stocks? That is what we are going to look at in this video. Don't forget to smash the like button if you enjoy this video. It makes a tremendous difference in terms of helping the channel grow. And of course, click on the subscribe button if you are new here. Now, without further ado, let's get right into it. So let's start off right with the juicy part of the corporate insider buy-sell ratio on XLK. And you can see this ratio ever since October of 2022 has been in a free fall as we've had less and less corporate insiders buy stocks and more sell. Now, of course, these readings here, very low readings. This is actually the lowest reading we've had since around 2020 here. They don't always end up causing an actual crash in the market. So I want to mention that right off the bat. But when you do have corrections, for example, like in COVID, right here, the insider buy-sell ratio at the lowest possible level right here. Before the 2018 crash right here, you also had the buy-sell ratio at very low levels. Before the 2015 consolidation here, a 2-year period in the market where you had 10-15% drawdowns, you also had the buy-sell ratio at very low levels. And when this ratio is elevated, you can see that's typically a very positive signal. You can see here the buy-sell ratio surged as you had a small crash here in 2015, and that elevated ratio marked the bottom. Again in 2018, stocks crashed, the ratio surged, and that marked the bottom. And again, more recently, here in October of 2022, you can see buy-sell ratio at its highest level, marking the bottom in the market, and was eventually followed by quite a considerable rally here. So you do not have that setup anymore where insiders were buying up their stocks that were cheap back here. You actually have the mirror image of that right now, and I'm going to show you in just a second exactly why they're doing that, because their stocks are historically expensive right now. And so if you're a corporate insider, you know your company in and out, you know what it's worth, you know what price it's trading at, you don't want to be holding a stock that's overvalued. And by the way, as a quick disclaimer here, we're not always this pessimistic on stocks. XLK, so the technology sector, is actually an index that we added to the model portfolio on our website back in September. So as XLK was trading at around $123, and we took profits on that position back in February here after a record outperformance in tech stocks. We're very transparent about our track record on the model portfolio. All the bets that we make are recorded on the website. So if this is a service that you think you would be interested in, don't hesitate to take advantage of the free trial that's on our website. But now if we take a look at the technology sector's PE ratio, so the valuation, how expensive these stocks are relative to the S&P 500, tech stocks right now are trading at very high valuations while their earnings are actually going down. This is a quick glimpse of the type of research we post on gameoftrades.net. So these tech stocks, after an almost 20% move, have gotten expensive. Their valuations are sky high, and yet their fundamentals are deteriorating right now. So the biggest driving factor behind the market right now, technology stocks, look extremely vulnerable. Now we also got the data for this insider transactions ratio that has been surging more recently to the highest levels since the January top here, or January-February top, where insiders were selling here. And before that, it was in August of 2022. So of course, August of 22 right here, January-February top right here. We're also seeing signs that insiders more broadly on the market are selling their stocks. And meanwhile, a lot of people right now are saying that there's too much short interest for the S&P 500 to move down. You can see this is a chart of the net speculative positioning on the S&P 500 that's the lowest right now since 2011. You can see that marked a bottom in 2011. It marked a bottom in 2015. It marked a bottom in 2020. This is something we covered in our last S&P 500 memo this week. We actually did a quantitative backtest of this data to understand what's going to be happening to fit that into our tactical strategy near term on the S&P 500 and walk you guys through our base case scenario, the timeline for the stock market from current levels. But you can see very broadly that, yes, it did trigger some bottoms, but if you look at the top of the market in 2007 here, look at how short positioning was at the very top of the market here. That certainly did not play out for a bottom in the market. In fact, it almost marked the exact top of the market before a vicious bear market. So what makes the difference between these instances where this did mark a bottom and with 2007 where it marked the top of the bull market? What's the key difference? Now, in our opinion, a lot of the difference between those two instances are just all about the Federal Reserve and the current monetary policy we have. You can see in 2011 around here and in 2015, let's say around here, the yield curve was extremely steep. You can see this is the 10-year yield minus the 2-year yield. And so when the yield curve is very elevated here, it means that monetary policy from the Federal Reserve is very loose, because short-term rates, so the 2-year yield, for example, is much lower than long-term rates that are a lot more influenced by long-term economic growth. And you can also definitely make the case that in 2020, the massive stimulus, the fact that the Federal Reserve cut rates to 0% was what triggered the massive run on the S&P 500. It wasn't the fact that short interest was extreme back then. These instances here just happened to occur at a moment where monetary policy was easy, and so that created short economic booms following those corrections. In 2011, you had QE. In 2016, you had tax cuts that led to an economic boom. In 2020, you had a record amount of stimulus and a zero interest rate policy that created booms in the economy, fueling much larger runs in the market. In 2007, however, you look at where the yield curve was throughout this period, it was very tight. It was inverted, meaning that monetary policy, so the 2-year yield, short-term rates, were very high relative to what the bond market was pricing in terms of economic strength. And so that did not lead to an economic boom. It led to an economic recession where the unemployment rate began to rise. And if you look at the macro conditions today, they look a lot more like they did back in 2007, where monetary policy was very tight, rather than in 2011, 2015, or even in 2020. So we don't think that today looks anything like these successful signals, and a lot more like what was happening here. Now, of course, we don't necessarily expect a full-blown financial crisis like in 2008, but an economic recession is definitely within the cards over the next year. So I hope you guys enjoyed this video. If you did, don't forget to smash that like button as hard as you can and click on the subscribe button if you are new here. Now, in the meantime, I wish you good luck on your trading and see you next time.